Your investing should be boring. Right? If you want excitement, take a little bit of money and go to Las Vegas. You don't want to do it with your overall retirement plan, but a lot of you are. We've had a nice big bull run in the overall stock market over the last several years, and guess what? Maybe a lot of you might be taking on more risk than you should. You want to find that target rate of return. Just real quick, simple points. You want to save as much as you can on a regular basis. Right? Save as much as you can and continue to save those dollars. Most of us need to be invested in stocks and in bonds. What Alan talked about, this is called an asset allocation approach, how much money you have in stocks versus bonds. Over 90% of the variance of your returns is going to be based on your asset allocation. It's not necessarily timing the market or investing in particular stocks. We look at what is the highest probability of success. So you have to start with that target in mind and make sure that you take the least amount of risk possible to get that target rate of return. It could be 4%, 5%, 6%, and so on, right? You want to make sure that you take a look at costs, okay? So there's low cost, there's high cost, there's medium-sized cost. You know what? Yeah, this is a factor because that could be a huge drag on your overall return. Unfortunately, the financial services industry is not very transparent. You don't necessarily understand what you're paying. And a lot of you that are watching this right now, if I asked you how much are you paying in your overall 401k or in the investments that you're choosing, you might say, I'm not paying anything. Maybe because you're not paying an upfront commission, but there's always cost fees associated with any type of investment. You just want to identify them. And then rebalancing. This is key. A lot of you need to start rebalancing your portfolio right now, because if you look at the big bull run, right, you might have started with 60% stocks, 40% bonds, but now because the markets are up over 200%, you might have 70, 80% in stocks and 20% in bonds. In my opinion, as you're approaching that retirement date, that is taking on way too much risk in the overall portfolio. It might look good on your statement right now to say, hey, look at these great returns, but we all know what goes up must come down. You want to make sure that you hedge against that.